2 seconds. Thank you so much for recording. First of all, thank you so much to Professor Sabri for being a speaker today as our webinar 6 title Inalienable Human Capital and That Choice, Evident from Quasi-Exogenous Shock. Sabri Boubaker, our speaker today, is a professor of finance and joined EM Normandie in 2019. He has a PhD from the Université de Paris-Est, and his research interests are the ownership structure and control of listed companies. Professor Boubaker has extensive publication record with over 90 publications listed in Scopus, along with over 2,000 citations so far. He is the co-founder and co-chair of the annual Paris Financial Management Conference and the Vietnam Symposium in Banking Finance VSBF series. He's also president of the International Society for the Advancement of Financial Economics. Professor Sabri is also the editor-in-chief of Journal of International Financial Management and Accounting. And today's our topic for webinar 6 is human capital and that choice, evident from quasi-exogenous shock. Professor Sabri, the stage now yours. You can start your presentation now. Thank you so much.
Thank you very much. Thank you for your kind invitation. It is my pleasure to be with you today to present my paper co-authored with Xiaoran Ni from Xiamen University, China, and David Ying from Miami University in the States. The paper is dealing with one of the most important exogenous shocks or quasi-exogenous shocks in the US, which has impacts on human capital and the mobility of human capital in the US. So the title of our paper is Inalienable Human Capital and That Choice. And basically, human capital is an important asset for companies. And you know, to win the marketplace, the first battle is a battle in the workplace. You need to attract the most highly skilled employees, those that can help the company move forward and produce high quality products. And this is what has been mentioned by almost all CEOs of companies. And the nature of the firm is actually a unique combination of assets that are physical fixed assets and human capital that can, to some extent, depending on the state in the US or in the country around the world, move easily from one company to another and from one country to another. Human capital is different from physical assets because it has this inalienable nature. That is, we do not have full control of key employees. You cannot keep your key employees in the company without allowing them the possibility to go elsewhere. And this has implication on the choice between bank debt and bond debt, and has implication also in debt, bank debt contracting. And to motivate our paper, we have many, let's say, quotes from top CEOs who are mentioning the importance of human capital in their companies. And one, for example, of the Apple's biggest stars, the chief design officer, Johnny Ive, when he has announced his shock and unexpected resignation, the shares of Apple plunged, okay? And the news was a huge blow to Apple, causing a fall of 1.5%, okay, which was representing a massive sum of something like $9 billion drop in value. And this was, let's say, something caused in a few hours. And one of the financial analysts who was tracking Apple, okay, called the announcement as a surprise to Wall Street. And he has mentioned that, okay, this has left a big hole in the company and it is clearly irreplaceable. So this means that, you know, some key employees, it is very difficult to replace them. And this is on the left, you have the tweet of of the employee has resigned, and on the left you see the stock price plunge. You see, so what was John's worth to Apple seems to be at least 10 billion dollars, which is a huge amount of money. Okay, another, let's say, important insight from about the importance of human capital. It was at the very beginning of the COVID-19 when US President Biden calls for giving the intellectual property, giving waivers of intellectual properties of the COVID vaccine to developing countries to be able to produce their own vaccine and not wait, let's say, for the US and other developed countries to provide them. And this was, and this argument that this was a global health crisis, and for extraordinary circumstances, you know, we need to have unprecedented measure, and among these unprecedented measure was waiving the COVID vaccine IPs. However, many of the CEO of many vaccine companies, they have declared, we don't care that much. Okay, despite that, they will put their IPs public at that moment. So what they have mentioned is that basically, even if IPs will be waived, other companies in different parts from the world will not be able to make the vaccine, as these companies have attracted the best top tier engineering around the world who master this messenger RNA vaccine. So no one top, let's say, engineering has been left for these companies. So even if you have the IP, you cannot make it yourself. Okay, so human capital, actually, which are really important, and all the studies show that they are really important, they do not fall under the category of collateral. When you take loans from the bank, okay, which is something really important to give collateral, you cannot give, let's say, your human capital as collateral, and banks cannot also set, okay, easily to when and to which extent and to which level your employee will be, let's say, in your company. So although prior studies have examined the effect of inalienable human capital on debt contracting by considering corporate debt as uniform, which means no difference between bank debt and bond debt, all are the same. However, how this inalienable nature of a human, the fact that human, let's say, key employees, key talented employees can move from one company to another, this is something that it is difficult actually to keep in the company, and it is difficult to, let's say, analyze its effect on debt. So in this paper, what we aim to see and what we aim to investigate is how firms address the increased threat of losing inalienable human capital. There are some laws in the US that allow employees to move freely from one company to another without, let's say, stringent condition on keeping trade secret in the company, without stringent conditions that limit their free movement from one company to another. So for this, we take the advantage of one quasi-natural experiment, which is the inevitable disclosure IDD. And here we will focus on the rejection of this IDD. And let me explain what is this inevitable disclosure doctrine. So this is a legal doctrine that prevents a former employee from one company to work from a rival company. So you cannot go easily to the competition, and if doing so will inevitably push the employee to disclose some private and proprietary knowledge and proprietary information and trade secret to the company. So if moving from one company to another will lead to disclosing private information, proprietary knowledge, trade secret, so in this case, the employee is prevented to move from one company to another. This law has been implemented in many states, but many states, after implementing this law, have rejected this law, allowing employees to move freely from one company to another. So this is what we will be working on today. More ease, more flexibility for employees coming following the rejection of the IDD. So our shock here is rejecting the IDD, rejecting the inevitable disclosure doctrine means allowing individuals, allowing key employees to move freely to the competition, which is a big threat. Okay, when you know that your employee employee is able to move from one company to another, and he has chances to disclose some proprietary information to give his private knowledge, private, let's say, skills that he has developed in your company to another company, this will change how you are perceived by bondholders and how you are perceived by banks. Okay, so by rejecting the disclosure, the states remove an important mobility restriction for employees who offer valuable and sometimes irreplaceable human capital to the firm, which increases the chances of human capital outflow. So far, up to the moment when we have started writing the paper, there were 15 states in the US that have rejected this IDD. This means that they have allowed the employees of the companies established in their states to move freely to the competition. And these are the states, okay? These are the states. So you can see here, Arkansas in 2009, California 2001. The first one that has rejected this law was Virginia, and the last one, it was North Carolina in 2014. So these are the states that have allowed their employees to move freely, let's say with less constraint from one state to another within the United States. So the rejection of the IDD can induce firms to rely on more private debt compared to public debt. And what are the reasons here? Why we are expecting this relationship? Why we are expecting that companies that reject the IDD to rely more on private debt compared to public debt? You know, the key paper that was at the origin of, let's say, understanding the debt contracts was Hart and Moore. And what they have said basically in their 1994 paper, they say that the renegotiation of debt contracts is a crucial mechanism when you have employees, okay? You are, let's say, labor-intensive company with high proportion of white-collar employees. Why this reasoning? Because since entrepreneurs can always threaten, okay, to repudiate a contract by withdrawing his human capital and moving from another to another company, okay, the parties that negotiate debt contracts, okay, will have difficulty to assess, let's say, the frontier of the company. And the firm will benefit from this renegotiation because the firm will have the possibility to renegotiate their contract. So if the entrepreneur is retained and he will take the loan, its assets will combine both human capital and will be worth more. And since the entrepreneur cannot commit not to repudiate the contract again in the future, there will be like a continuum of optimal debt contracts and the parties can renegotiate many short-term contracts. So this is the philosophy underlying Hart and Moore paper that we have used to expand his theory in our context. So in this case, the rejection of IDD, what is the main implication? Is that it will induce firms to rely more on private debt. So firms that rely more on key talented employees are riskier than others because you control your fixed assets. Your fixed assets will not fly to another company, but if you are relying more on key employees who have the possibility to move from one company to another, you are facing more risk of losing your key employees. And the probability of losing key employees to rival should not reduce the current value of the treatment of intangible assets and expected future cash flows from these assets, but also highlight the importance of the timely revaluation of these assets, because the value of the company depends on the value of the key employees. When these key employees will move from one country to another, the value of the assets and what you can extract from the assets as cash flow will vary. So private debt financing has a significant advantage over public debt because private debt can allow first monitoring efficiency. Banks are better able to monitor, less free riding compared to bound debt. And also this and firms like these need more monitoring. They have more need for monitoring. So these companies should borrow more from private banks compared to bond market. Alternatively, The rejection of this IDD can induce also firms to rely on public debt. And here you have a tension because both reasoning are possible. One reasoning that makes companies rely more on bank debt, one reasoning that makes companies rely more on bond debt. So both reasoning, they coexist, both are possible. Why this reasoning is possible also? Because banks compared to bondholders are more likely to closely monitor borrowing firms and are prone to losing key employees. So firms that face higher risk of losing key employees may want to shift away from bank debt to avoid bank monitoring. So it depends when you are from, let's say, the supply side or from the demand side of debt. You can have the need to avoid bank monitoring. Shareholders would like to be under, the company would like their company to be under the monitoring, under the scrutiny of the banks. However, the CEO of the company would like to avoid bank monitoring. So the likelihood of losing human capital to industry rival creates a more competitive product market, which is itself disciplined corporate manager, and the ex post governance theory of bank debt suggests that the marginal benefits of bank monitoring decreases when governance is improved, and here the governance is improving by having and being under the threat of losing key employees. So in the sum, the net effect of rejecting the IDD on that choice is an empirical question. Some reasoning are in favor of more bank debt, others are in favor of more bank debt. So what are our main findings here? Okay, so our main finding, the first one is that we find that the treatment firms, those that are located in states that have rejected this IDD, allowing key employees to move freely from one country, from one state to another, rely more on private debt financing. They avoid bound debt financing. This effect is stronger for firms that rely more on human capital, key human capital, that they need is key human capital, that have fragile fundamentals, means those that are facing financial constraints, and those that suffer from high information asymmetry. And basically these are our channels. So we have one channel that is, let's say, information asymmetry. We have one other channel that is more monitoring. This is what we'll see later on. So overall, our findings indicate that this inalienable human nature of capital means the difficulty to retain key talented employees offer for the company the possibility of having flexible negotiation of debt. Each time when you lose, let's say, a important fraction of key employees, you can negotiate the debt contracts, which is possible with banks, but not possible with bondholders, okay? And this is one of the important benefits of a private debt in reacting to the risk of losing key talented employees, and companies are considering this. Okay, contributions, we are contributing basically to two strands of research. The first one is that we are extending the work of Hart and Mort by emphasizing on the inalienable human nature, on the choice between bank debt and bound debt. However, in their paper, they have worked on whether the companies would prefer short-term debt or long-term debt. This is one of the major contribution, okay? The second important contribution is that to the theory that are working and examining the debt choice. Very few papers have examined labor-related factors and their effects on that choice. Among these, you have Chen in 2017, who shows that strong organized labor prefer bank loans to public bonds. And in their paper, they have shown that this is, when labors are strong, we rely more on bank debt more than on bound debt. Q also in 2017 shows that the structure is adjusted toward public debt and away from bank debt when employees have better bargaining power. And another paper from one of my co-authors in other works, Ben Nasser shows that an increase in unemployment insurance benefits its firms to rely more on bank debt. So basically, when these employees have more power, companies are more, let's say, more inclined to rely on bank debt. And basically, all these studies above, they consider that bargaining power within the firm, okay, which is something different from the inalienable nature of a human, okay, has impact on the choice between bank debt and public debt. Our paper pioneering the study of the threat of losing our key employees to a rival company and its effect on that choice. Okay, we contribute also to the recent literature that starts back to 2018 on mobility of employees. As you know, there are many papers that have worked on the IDD, not on the rejection of IDD. On the rejection of IDD, there is, to the best of our knowledge, only 1 or 2 papers that have been published. So the key paper here is Klasa in 2016, who employ a staggered IDD shock, okay, and shows that firms increase debt, but they have not distinguished between bank debt and private debt and bound debt. They show that companies increase debt when they have a risk of losing intellectual property by losing their key employees to their rival. So this company will rely more on debt compared to equity, and the reasoning is here very simple. It is very difficult. It is easier to negotiate, you know, debt compared to, let's say, equity. So they do not distinguish here the choice party because the IDD of, let's say, maybe events that have used are before 2000. Before 2000, we don't have detailed data on the difference between bank debt and bound debt. So our paper will add to this literature. Let me go to the data. So the data are basically from Compustat, CRESP, and Capital IQ. The timing of the rejection of the IDD was from Flammer and Kasperczek. We have also checked beyond the date, the end date of the paper of Kasperczek, whether there are other events or not. Our sample period is 2003 to 2007, 18, and we have almost 18,000 firm year observations. Our key dependent variable is bank debt, which is the ratio of private bank debt on the sum of bank debt and public debt. This ratio is commonly used in this literature, and bank debt here, it includes term loans and revolving credits, and public debt, it includes subordinates, bonds, notes, senior bonds and notes, and commercial paper. The key variable is IDDR, which is a dummy variable that equals to 1 if the firm is headquartered in a state that has rejected the IDD by the end of a year. So if the company is located in a state that have rejected this IDD, you know, this variable takes the value of 1, 0 elsewhere. Control variables are the same as in the previous literature. This is our model. We use a diff regression. Our dependent variable is bank debt. Our key independent variable is a dummy variable for the firms that have headquartered in states that have rejected this law. We control for firm fixed effects. We control for year fixed effects, and we cluster the errors by state of headquarters. Okay, this is our main result in our baseline model. So as you can see here, our key independent variable in the diff regression is IDR, which has a positive and statistically significant and economically significant effect on bank debt. Means that in states where the law has changed in favor of more mobility of employees, company will rely more on bank debt. The economic significance is important, so relative to the sample mean of bank debt, which is roughly 51%, the coefficient, as you see here, allows us to see an increase of almost 9% in the private bank debt compared to the average of the sample. So there is almost 9% increase of bank debt. This means that firms, let's say 1 year after the event, they switch to some extent from bound debt to bank debt. Okay, here we have tested the timing of the choice, and as you know, when you have a different regression, you need to make and you need to test the parallel trend assumption. So we have created a list of dummy variables. The first one is IDDR -2, which takes the value of 1, 2 years and before the change in the law. Here, 1 year before, the year of the event, 1 year later, 2 years later, and after that. And as you can see, the coefficients are not significant before the event, okay? And this coefficient are positive and economically significant, and they are increasing from 1 year to another. This means that companies started the year of the change in the mobility of their employees. They start, let's say, moving and switching from bound debt to bank debt, okay? So here we use, as you know, endogeneity is one of the biggest issues, so DIF can tackle to some extent endogeneity, but we've tried also to use propensity stock matched sample in parallel to the DIF to better control for the confounding effects. And as you see also here in the first regression, you see the coefficient of IDDR is positive and statistically significant when you use a matched sample, but in the second current, the parallel trend assumption also holds, and the coefficients are positive and statistically significant only the year of the event, the year later, and so on, but not before the event. This means that there is like a drift in the a change in the bank debt by increasing more following the event. And as you can see, the coefficient increases from 1 year to another. We have not run a test to see whether this increase is significant or not, but you can see it easily. Okay. Then after establishing this first regression, we try to run some cross-sectional analysis to explore the characteristics of our regressions. And here what we have done, we have estimated a triple difference regression model using a stack cohort approach. You know better than me that there are some recent literature started from 2021 that are questioning this DIF in DIF regression. So they have advocated the use of stack cohort approach to reduce some problems linked to the DIF and DIF regressions. So firms that depend more on human capital will be more concerned about losing key employees. So this is the first test that we will be running. This relationship is more exacerbated in companies that rely more on key human capital. Another element is having a bank loan is more beneficial than a bound loan for firms with more, let's say, financial constraints that are more under the threat of losing their key employees. When you have financial constraints and you don't have a sound financial position, you are more likely to use your key employees. So this relationship should be expected more important in this case. And also we are expecting that this increase the threat of losing key employees will be more important, and it would make it also for creditors more difficult to assess the value of future cash flow generated by human capital, which is an intangible asset, in particular when borrowers face high information asymmetry about the company. So basically here we are testing three things. The first one is whether this relationship is more exacerbated when we rely more on key talented human capital. The second point is when we have financial constraints, and the third one is when we face information asymmetry. So this is the model that we are testing, bank debt as dependent variable, and then we have our IDD variable, and we interact our IDD variable with these proxies of financial constraints, proxies of information and asymmetry, but we start from with proxies of to which extent we rely on human capital. So we'll follow here Gormley and Matza in their two key fundamental paper 2011 and 2016, and we adopt the stack cohort approach, and we estimate a triple difference regression to study whether this relationship is heterogeneous or not. Okay, so I will not go in details on the econometric implementation of this, and I will go directly to the results of the regressions. So as you can see here, we interact our variable with key human. Okay, this is a first variable proxy one of the quality of human capital is Q1. The first proxy is Q human, and the second proxy is spill. Okay, these are two proxies that that measure the extent to which employees are or can move from one company to another. So let's see these two proxies first. The first one is Q human, which is taken from Israeli and Yonker 2016, which is a proxy of the key man life insurance disclosure from SEC filing to identify firms exposed to key human capital risk. As you know, when you have key talented employees at the top level of the company, usually many companies buy life insurance for these individuals, and many also by the SEC that are constrained to disclose information on these, let's say, life insurance company. You buy life insurance company when you have the threat and you are afraid of losing your key talented employees by dying. You know, the second paper is Spill, which is from Bloom et al. 2013, which is the closest, the closeness of a firm relative to its product market rival. So, which means that when you have more rivals in your industry, you have more chances of losing your key employees. Why? So firms facing higher threat of losing key employees to product rivals when they work in similar area. Okay. So basically here, what we predict here, let me go back to the previous slide. We predict that the rejection of the IDD will have stronger impact when the company has more chances to lose their key employees. The rationale is very simple, and this is one of the channels. Okay, so the underlying channel that drives the results is the threat of losing key employees. Okay, the effect should be stronger among firms that depend more on key employees. So these firms will be more important. As you can see here, okay, the coefficient of the interaction terms are positive and statistically significant, means firms that rely more on key employees have shifted more to debt financing compared to bank debt for financing, putting more and larger proportion of bank debt financing in their debt structure. So you can see here the coefficient is positive and statistically significant, which means that the more you rely on key talented employees in your industry, the more you will shift for bank debt, because the threat of losing your key talented employees is more important and you need more debt renegotiation from your bank. So this is the reasoning. The other channel is regarding the financial health of the company. And basically what we are expecting here is that firms that are financially unsound, facing more financial difficulty, will have more chances maybe to default, and they will prefer going for private debt to be able to better renegotiate their debt compared to bonds when it is very difficult and almost impossible to negotiate debt. So what we use here as a proxy of financial constraint, we use firm size and we use weighted Wu index, two indicators of firm financial constraints. And as you can see here, okay, to the size, as you know, when you have higher size, okay, larger size company, usually they face less financial constraint. However, here, when you have larger weighted Wu index, you have higher financial constraint. That's why the interaction terms in both cases are in the opposite side, okay? But the reasoning converge. And here, lower size means positive coefficient, okay? Large size means smaller size means in our case more financial constraints, and here higher weighted Wu means higher financial constraints. So the effect of the positive effect of IDDR that leads to more bank debt seems here to be more exacerbated for small-sized firms and firms that have higher financial constraints index. This is consistent with our reasoning that facing financial difficulties, firms need more to renegotiate bank debt, makes them choosing more bank debt, and this is more important when you face the risk of losing your key talented employees. We have used also two other proxies of the financial, let's say, financial unsoundness of the company, or the potential financial difficulties of the companies. We have used the volatility of cash flow of operation, and we have used also a return on assets. So what you can see here is that when you have highly volatile cash flow from operation is a synonym of financial difficulty, potential financial difficulty, potential financial risk. And you can see here companies use more bank debt to be able to better renegotiate their debts. Here, when we use a proxy of return on assets, and higher return of assets means better financial conditions, but lower return on assets means lower financial condition. And we see here a negative effect, means that higher financial constraints, higher financial constraints will lead company to avoid bound debt and to go for more bank debt. So we predict here, and we show that firms with more volatile stock prices and low quality financial performance, worse financial performance, are exposed to higher risk of financial distress and threat of losing their key talented employees, making these firms relying more on bank debt. Why? To be able to, let's say, renegotiate their debts following the rejection of the law. The last channel that we are testing is information asymmetry, and the channel is basically based on the reasoning that an increased threat of losing key employees is an important risk factor, making the need of for banks to monitor the company, or you are better able to monitor the company when the company suffers from less information asymmetries. So what is the reasoning from the private lender's point of view? So and what we see here, we use two proxies of monitoring. The first one is analyst coverage. So companies are followed by more analysts and are more under the scrutiny of financial analysts. And the other variable is the presence of institutional investors in the capital. And when these two variables increase, this means that the company is better monitored by institutional investors and by financial analysts. And what we see here, we see that when the companies are not monitored by institutional investors, not monitored by analysts, means low value of coverage, low value of institutional investor. This will lead to a positive effect on bank debt. However, when you have more financial analysts, more institutional investors, the coefficient is negative and significant, means that the monitoring that is made by banks, that is made by analysts, the monitoring that is made by institutional investors will allow this company to suffer less from information asymmetry, making the task of banks more easier. Okay, so this is the reasoning. As you can see here, the coefficient on the interaction are negative, so our main result is that is less significant for firms that are covered by more financial analysts or with higher institutional investors, and meaning that the rejection of the IDD leads to an increase in labor mobility risk, requires additional monitoring. The proxies, you know them. Okay, here we ran other regressions, and what is the reasoning underlying running other regression with other alternative dependent variable? As you know, our key dependent variable is bank debt divided by bank debt plus bound debt. So the ratio can increase not due to the increase in bank debt, but due to the decrease in bound debt. This meaning that the situation will not lead to a real increase in bank debt, but a decrease in bound debt in a higher proportion. So what we have used here, we have used a variety of dependent variable to check whether this rejection of the law leads really to more bank debt or not. So we have used leverage, which is the total debt to total assets. We have used also the ratio of public debt to total debt. And the second regression, we have used also the ratio of bank debt, and we found here that the coefficient is negative when it is a matter of bound debt, and the coefficient is positive when it is a matter of bank debt. Here we have used the ratios that are deflated by total assets. The same ratio here are deflated by the market value of the company. And as you can see, the coefficients are consistent, okay? Here, what we have used here, we have used another key independent variable that can have the same spirit as our rejection, which is state level non-compete enforceability index. And what is this index? It is an index that has been made on a state level that shows you to which extent, let's say, the courts in that country can enforce laws of non-competing, means reducing the chances of employees to move from one company to another. So what we conjecture here, we conjecture that stronger state level non-compete enforceability should have the opposite effect as the rejection of the IDD. When you can have this in a country, more constraints that are enforced at the state level to keep your employee in your company without being able to move to the competition, so we will expect less bank debt. So this is what we see by our regression. We see what when in the state we are able to keep our employee because we have this index will lead less to bank less debt. So an increase in the non-compete enforcement will decrease the mobility of key human capital, which reduce the need of monitoring and the need of renegotiation of debt, decreasing firms' reliance on bank debt. So this is what we see, and we see that this result from this new proxy is consistent with our main findings. Okay. Sorry. Oh. Then we ran some other robustness checks. I will not spend time on them. So here we ran some robustness checks with higher degree of fixed effect. So as you know, it is one of the difficulties is to control for this endogeneity, and this endogeneity is a big trouble, and this is a thankless exercise that the more you need, the more you do, the more is requested by referees. So in the first regression we ran industry times year fixed effect, so to control for differences out of all the confounding factors that vary from one state to another. In the second regression we include, as you see here, industry times year fixed effect and state of incorporation times year fixed effect to control for omitted variable within the state of incorporation and year, since corporate governance could be a very important determinant of that choice. And the third regression, we include region times year fixed effect as a higher degree of fixed effect and to control for omitted local economic condition and local political economic factor that can affect the results. Okay, so the results, as you can see here, the results remain positive and statistically significant irrespective of the higher degree of fixed effects. Here we ran some additional robustness checks. In the first regression, we ran a stack cohort approach, and you can see here why we do it to deal with weighing and bias issues due to the use of traditional diff and diff regression, especially staggered diff and diff regression. And the second regression we use regression that are with standard errors that are clustered by state and the year. Here we exclude the financial crisis period, and here we exclude the years of the change of the law because we consider that maybe for some states the change in the law was made by the end of the year, so the company have not enough time to readjust their debt structure to that. And as you can see, irrespective of the test, the results remain positive and statistically significant. Here we ran other checks in the fifth column. We exclude firms that are located in California. Why? Because in California, we prohibit any sort of non-competing agreement and have a large number of technology firms due to the Silicon Valley. And these firms have many, how to say, key talented employees that can move within the state or from one state to another. Column 6, what we have done, we have excluded firms headquartered in states that rejected the IDD during and before 2003, which means early adopters. Here in this regression, we excluded firms with geographically dispersed industry, when one employee can work in two different, let's say, states, okay, one state that has adopted this law, one other state that has not adopted this law. And in the last regression, we have excluded firms that in our period have changed headquarters. And as you can see, the results are statistically significant. So basically, we reached the end of this presentation, and what we can see here is that what is the takeaway of our paper? The takeaway is that we have examined shock, which is the rejection of the IDD, which is the inevitable disclosure doctrine that allows to move easily from one company to another, in particular to rival company, with the risk of taking with them trade secret, taking with them proprietary information, and taking with them key information that allow the competition to benefit from these information at the expense of their former employees. We have exploited this shock over a period from 2003 to 2018, and this shock will facilitate the move from employees from one company to another, and firms that are located in these states have been considered as treatment firms. Other firms have been considered as control firms. And our main key important result is that the rejection of this law comes with more bank debt compared to bound debt. This effect is more important in firms that rely more on key talented employees, in firms that have more, let's say, unsound financial situation, and in firms that suffer from more information asymmetries. So, so our findings, they contribute to the literature, because we have revisited this question of the importance of the inalienability of human capital in affecting debt contracting. And particularly here, we have not assessed the choice between long-term debt and short-term debt, but the choice between public and private debt. We reached our final slide. Thank you very much for your attention, and I welcome all your questions, remarks, and suggestions. Thank you very much.
Thank you so much, Professor Sabri, for your nice presentations. Anyone have questions? Please raise your hand. Khánh Hoàng, please send your question.
All right, thank you very much, Professor Sabri, for your presentation, and I would love the empirical analysis, especially the Quasi-Exogenous test. There's one thing I'm thinking about this topic is that they're very important factors that can, drive the results or maybe contribute to the Quasi-Exogenous analysis. That is corporate cultures. And we have recently we have a study from Review of Financial Study last year that measuring corporate cultures using machine learning. So they have the data for 5 different dimensions of corporate cultures, that is innovations, teamwork, respect, integrity, and quality. So I think that may be a good factor to incorporate into the analysis. I'm going to send the study here, and I requested the data from the author, and they sent me right away. So I believe that might be a good one for you too.
Yeah, thank you very much. Yeah, we are. Yeah, thank you for sending the paper. I will check it with care. I fully agree with you that culture is something very important in affecting that choice. This is really very important factor. Up to now, we have not included this because we have controlled for for firm fixed effect, and we consider that culture is something that do not vary from one year to another. Of course, if culture vary from one year to another, this will be another thing. But thank you very much. I will check the paper, and if these measures of culture at the firm level are available, we'll be happy to include them as additional controls to check the robustness of our results, to including them as additional control variable. Thank you, Khan, for your comment.
I just want to add that it's changed over time, the score for corporate cultures for 5 different dimensions. So that'll be
okay. So they show that it varies. Yeah. Okay. So maybe in this case, if we have the variable, we will include them and we will include them and we'll interact them with the time dummy variable to check whether the results remain robust or not. Thank you.
All right.
Thank you so much. We have question from Glow Change. Please.
Yeah, thank you. Thank you so much. I thank Sabri for the wonderful presentation. The topic is actually very intriguing as well. I just have a very simple questions. So since you mentioned before that the rejection of IDD actually will reduce the barriers for label mobility, which I completely agree with that. But as I can see from the paper, most of the empirical tests focus on state level. So I'm just wondering whether there will be a split over across states, because most of this literature that study labor finance, they tend to use, for example, a community zone or labor market areas, which was, I think, developed in 1990s, if I remember correctly, because there will be some labor mobility or traveling or flow between these states, like across the state lines. So if I remember correctly, for example, some states in Ohio is in the same community zone with, let's say, Kentucky, if I remember correctly, but obviously Kentucky is not your treatment group, it's the control group. So I'm just wondering whether this will be another factor that you can consider of this like spillover of labor mobility, given that this is your main argument.
Yeah, thank you very much. Yeah. This is possible also. This is possible that your key employees will move from one state to another within the same company. This is what you are mentioning, huh? Okay. Yeah. What we have done simply is we have considered firms that have let's say that are industry dispersed within the United States. Okay, with all activities are not located in the same state, okay, and we have run regression without these firms. So we have considered only firms that have all their operation in one state, okay, and we have run regression only on these firms. But we fully agree that this is possible, okay, and employees can move like that. There are some factors that we are unfortunately unable to control. For example, you know, the study is only on the US. There can be also spill over outside the US also. See, you can have, but this is one of the limitation of the study. You can have a spillover outside the US, or companies, when they have this threat, they can locate, let's say, part of their business in another country. But you know, unfortunately, we cannot control this only by excluding, let's say, some parts of the companies that have operation in more than one state, cutting them from the sample, checking the robustness of the results, or let's say considering companies that are operating only within let's say within the US, okay, without, let's say, large affiliates abroad. Thank you very much. Fully agree. If you can share with me the paper that I have mentioned in this, it will be I will be very thankful.
Sure. No. The reason why I raised this question is because I actually agree with our Harvey Nguyen, the chat room, that he mentioned that if you actually the paper said that IDD adoption will lead to firm increasing financial leverage. This is something that the labor finance paper now are suggesting right now. If you have labor supplies or you have a labor mobility, it will basically for most of the firms, they will decrease their indirect cost of financial distress. So which means in that case, if you have more labor mobility flow in, I should say, then most of the firms tend to increase their leverage, let's say. So for your paper, you tend to say that they increase their private debt or like private leverage. So that's the reason why I raise this issue is if the labor mobility is possible, then this might be another explanation to why companies tend to choose private debt, because they have more labor moving in, then they tend to increase their financial leverage and they tend to choose private debt. So that's what I'm thinking recently.
Yeah. So you are considering that, okay. So you are considering that this is not by losing only, but by having more employees.
Yeah. Huh? Yeah, because if let's say the rejection of IDD, you are afraid of losing your key human capital, but also there's a chance that other companies' key human capital might follow it. which would be a benefit for your firm as well,
Yeah.
right? So it will reduce your indirect cost of financial distress. So you might tend to increase your financial leverage as well. But in your case, you tend to argue that instead of just raise financial leverage overall, the firms tend to raise private debts as a way to increase their financial leverage. I guess there will be a stronger argument in your case.
Yeah, okay. Yeah. So maybe here what we need to do, we need to look for other control variable to assess to assess the number maybe of white collar employees in the company, whether they change or not, to check the net benefits in terms of employees for that particular company. Yeah, maybe. Yeah. I have copied paste. Thank you, Harvey, for your comment. I have copied pasted and I will check it with care later on. Thank you very much.
Thank you so much for the question from the audience, and thank Professor Sabri for your thought sharing with our audience. We still have questions from Khánh Hoang. Please feel free to share.
Thank you, Hai. Thank you, Sabri. And I'm totally agree with Chloe about the idea that the key players from other firms might, come to the firm we are observing. The one thing that probably we should look at the compensation packages of the like compensations, and also the corporate working environment where the firms as control variables or a mechanism for your studies. Probably I think that would serve very well for our new elements of the studies. And also I'm very sure that the data I suggested before can be used in the case, like let's say if you have different different in the corporate cultures, corporate environment, working conditions, there will be a better element to attract more key personnel to your firms, and that might be the idea.
Yeah. Definitely. I think we need to run additional regression with control variables that are linked to firm level corporate governance to better control for whether these companies attract more or less key talented employees. Yeah, thank you very much. Fully agree with you. I'm taking note.
Thank you so much. Any final questions from the audience? Otherwise, we're going to wrap up our webinar today. Thanks again, Professor Sabri, for your presentation. And honestly, with me, I have some thought, just very quick, that I recently keep an eye on the labor-related policy in the US, and particularly how the events policy like IDDs affect corporate financing decision, and your paper in that choice particularly is on the law of inevitable human capital. And of course, we receive a very helpful question and also thought from audience today in terms of the culture effect from Khánh Hoang and other point from audience, for instance, like the corporate default risk, and along the line with the IDD literature. And of course, when we're doing empirical work, sometimes to see whether we can attract and answer question more nicely and in a better way. And that's the reason why I'm very pleased to having you and our people today for the webinar, for our very insightful discussion so far. Any question? Let me check the chat. We have something. Thanks, Plank Glow Chen, for sharing the article. I hope, Sabri, you have saved it on your computer.
Yes, I have done it. Yeah, thank you.
Yes, and if we don't have any further question or final thought,
Hi. I think we have a couple of questions from Harvey Nguyen from Marcy in the chat. Have you got the question?
Yeah, I have copy paste them, but I can read them. Okay, hi Sabri, it's Harvey. Okay, thank you, Harvey. Great presentation, and I'm very enjoyed. Okay, just a comment regarding your findings. When I recall some related papers in the IDD field, Klasa all in their GFE paper, okay, show that IDD adoption also leads to firms increasing financial leverage. Fully agree with you. Lingzhan and Zhao in working paper show that IDD adoption influences bank to lower interest rates and longer loan maturity. Okay, so if we combine these two findings, IDD affects capital structures as increase in leverage, okay, and banks tend to offer more favorable because of that, leading to more bank debt. Okay, yeah, I fully agree. It is not surprising actually for me, this, because when this is the adoption of the IDD, but I fully agree, this is the adoption of the IDD that leads to more bank debt, to more debt on general. But what we find is that rejecting this IDD will lead to more bank debt at the same time, but the channels are not the same in the two papers. And I am not sure whether in their paper what they have found about the bank debt or the bound debt or not. Yeah, it seems to be like inconsistent in terms of results like this. But my argument is that, first of all, this is not the same period. Their period is larger than ours, is, let's say, almost 10 years before our period, or maybe 15 years before our period. Their period and ends before our period. Our period starts from 2003, so the period is largely a different period. This is a first point. The second point is that in their paper, when they have used this IDD, they have not distinguished between which kind of debt, and they don't give information whether the results that is in their paper leading from more, let's say, decreasing financial leverage. Is it basically decreasing financial leverage in which proportion? So maybe it is a high decrease in bound debt and a slight increase in bank debt, which is consistent with our result, basically. Okay, since they don't have the details of the combination of the debt, maybe what they observe is, let's say, higher financial leverage, and this higher financial leverage comes from by far more bound debt, higher increase in bound debt, but a decrease in bank debt. Okay, so since they don't have this distinguish, we cannot, let's say, actually have a clear-cut understanding of their reasoning. Yes.
Thank you so much. Yes.
Yeah, okay, thank you, Harvey, for sending this paper also.
Any final questions from the audience? And thank Harvey for your question on the chat. And I hope that that would be helpful for adding more mechanism in your papers so far. If we don't have any further question, please allow me to wrap up webinar today. It's been very informative and insightful discussion. And thank Professor Sabri again.
Thank you.
It's now time. If you are happy, everyone, please turn on the camera. We can